Well, if you're wondering why farmers are so concerned about their farm finances right now, they really just can't catch a break. It's not just because corn prices are below break even for most. It's the fact input prices are so high.
The U.S. has lost the corn crown. We've been the world's top exporter of corn for just about every single year in history.
China halted orders for U.S. soybeans and corn before tariff escalation. A crushing blow. USDA cancels. Local food purchasing programs that serve Humboldt schools, tribes, seniors, and food bank while supporting ranchers and farmers. Corn prices have plummeted to $3.50 a bushel, sending the entire U.S. corn belt into a tailspin. Over 2 million tons of corn were sent straight back to New Orleans by importers, turning million-dollar contracts into worthless paper overnight. From Iowa to Indiana, combines sit idle because harvesting now means deeper losses. Cracked kernels lie under the rain like a giant grain dump. While U.S. farmers stare at fresh loans and shattered confidence, Canada quietly plants its flag on a multi-billion-dollar supply pact with Japan, South Korea, and even Europe, staging a silent coup right on the world's dining tables. So why has U.S. corn collapsed so fast since early 2025? While Ottawa calmly seals deals that pour millions into Canadian pockets. Today's video will peel back every fracture in America's corn wings and decode how Canada ascended to the grain throne. Hit subscribe to Deep State and turn on notifications so you never miss our latest political economic updates. Tariffs are eating U.S. corn while it is still sitting on barges. After the White House imposed fees of up to $1.5 million per trip on China-built cargo vessels, shipping costs through the Gulf of Mexico jumped about 25%, pushing industry-wide export expenses up by $930 million a year. Trans-Pacific container rates showed no mercy either. In just the first 2 months of the year, ex-Asia freight rocketed to nearly $5,000 USD per FEU, double the post-COVID new normal. Yet the second knife cut even deeper: pesticide residue testing fees. On 14 March 2025, the Federal Grain Inspection Service issued Directive 9180.40, raising the multi-residue export test fee from 57 USD to 81 USD per sample. A 40% leap in a single crop cycle. Every U.S. corn lot now needs this green certificate, or risks being turned around mid-ocean. Costs ballooned, yet grain wouldn't move. The 6th February Grain Transportation Report showed barge traffic on the Mississippi down 16% against the 5-year average, while New Orleans berths clogged for lack of empty boxes and new security paperwork. More than 180 vessels waited at anchor, leaving Iowa and Indiana corn to soak and blacken. Farmers lose another 0.27 USD per bushel simply by waiting for a ship. Meanwhile, global import standards pivoted to clean plus green plus blockchain traced. In February 2025, Mexico enshrined a ban on GMO corn and favored pure grain with low-carbon certificates, a jolt that Asian and European feed mills copy-pasted into their contracts. The United States, with 92% of acreage GMO, was scratched off the whitelist, whereas Canada, proud of its Prairie Trace blockchain that tracks every lot, scooped up brand new billion-dollar deals with Japan, South Korea, and the EU. The impact showed instantly. Spot corn across Midwest scales plunged to $3.45 a bushel, the lowest since 2016, while Canadian offers in Manitoba held at $4.20 thanks to a carbon-free premium. Global traders merely shrugged. U.S. cargoes cost more, tests take longer, and they flunk the non-GMO clause. Better to switch to the maple leaf. The world corn map is being redrawn right on New Orleans docks. One side sees torn contracts piled high, the other waves Canada's flag atop cargoes fetching 20% more just for wearing a green label. With logistics and inspection bills still climbing, the question is no longer, when will U.S. corn rebound, but whether America's kernels still have a seat at the global table. Imagine the whole county of Shelby, Iowa, drowning in a sea of corn yet no one wants to buy. According to Reuters, unsold corn stocks held by U.S. farmers have shot to a 6-year high. The USDA estimates that by the end of September, more than 2.5 billion bushels, equal to 68 million tons, will still be trapped in silos, baking in sun and rain. The cash bid in Cedar Rapids this week sits at only $3.74 USD per bushel for September delivery. While average 2025 harvest costs in Iowa already chew up $165.75 USD per acre. That brutal gap explains why Midwest farmers are listing John Deere 6600 combines on Craigslist or driving Uber at night to patch cash flow. Reuters records some households holding back up to 90% of their crop because selling now only piles on debt. In Indiana, the story doesn't stop at money. The State Economic Council says the economy beneath the Corn Belt shrank 6.1% in Q1 2025, the second steepest slide nationwide. With incomes gone, food aid applications flood rural counties. The Food Bank of Indiana warns the number of households pleading for help is up by half versus a year ago, while a SNAP budget cut proposal threatens to erase 133 million meals for the poor. Crossing into Illinois, the domino chain shows itself as the Illinois-Mississippi waterway chokes on record low levels for a third straight year. Shippers must lighten loads and run shorter tows, adding $20 per ton to reach Gulf ports and delaying sailings up to 15 days. The result? Crops back up. Farmers stumble under higher interest, while land funds snap up acreage on the cheap. In April alone, the Midwest Farmland Deal Index still inched up 6.5% despite a cooling wider market. Some rural school districts have shifted 3 days a week to online classes to save electricity, says the CTE Rural Illinois report. Nebraska and Minnesota, dubbed the underground corn vault, now have to shut off the irrigation tap. A new Little Blue NRD rule slashes allocations to 13 inches a year per acre, forcing co-ops to halt purchases temporarily to avoid bursting bins. Towns along Highway 6 see grain trucks vanish. Gas stations post shell-out, and a diner in Hastings kills the grill before 6 p.m. for lack of patrons. The local paper calls it a zombie economy. Stores still standing yet cash flow dead. The final blow to the chain is ethanol. An EIA report shows Midwest run rates down to 87.8%, with 25 plants closed, idling 1.26 billion gallons of capacity. In Columbus, Nebraska, Valero's plant has axed 60% of night shifts, sidelining 120 workers. The corn demand market, already tight, shrinks further. From silos crammed in Iowa, barges locked in Illinois, to pumps shut in Nebraska, each broken link boots the crisis ball farther. U.S. corn, the Midwest's golden icon, not only loses value, it is suffocating the communities that live off it. While Canada's Maple Leaf calmly pockets billion-dollar contracts, the question for Washington is no longer when will corn rebound, but how many towns will turn into ghost towns before the price comes back. Canada isn't saving U.S. corn. Instead, it quietly carves out a luxury segment of its own, and does it so methodically that importers feel as safe as buying a Swiss watch. Every export container carries blockchain tracking from seed to terminal, leaving almost zero room for counterfeits. A Pharmanaut report notes that North American exporters now treat blockchain as the default for traceability, and Canada pushes it deepest thanks to a network of farmer co-ops concentrated in Ontario and Saskatchewan. But a traceability seal alone is not enough. Ottawa forces businesses to commit to the 3 no's: no GMO, no glyphosate, and no carbon emissions above the EU's RED2 threshold. The 2021 RED2 implementation guide demands that agri-supply chains prove their carbon footprint over the entire life cycle. Canada is the first country in North America to build a unified disclosure platform for corn, letting shipments clear EU customs 20 days faster than US grain. The payoff shows up on the price board. The The June 2025 Market Trends Report from Grain Farmers of Ontario records old crop basis running 1.30 to 1.87 USD per bushel above CBOT futures, a premium of 22 to 30%. Even new crop corn is fetching an extra $1.49 per bushel, at least 18% over Chicago. That number explains why Asian feed mills agree to pay more. They're buying a green reputation, not just kernels. The biggest boost arrived in March 2025 when Canada and South Korea signed the Organic Equivalency Arrangement, CSKOEA. EDC says the document flung the door wide open for organic grain, allowing Ontario co-ops to lock a 5-year supply package with major feed mill group just 3 weeks after the FTA took effect. At the same time, Saskatchewan leveraged a weak loonie and the tariff skirmish between the US and EU to sell non-GMO corn to Japan and the Netherlands. USDA Ottawa notes exporters are actively diversifying because of Washington's 25% SPA duty. Result: fall 2025 contracts for the EU are listed at an average 18% over CBOT, according to Rotterdam desk quotes. A level Midwest farmers have never dreamed of. Behind the curtain, Ottawa spreads a tight safety net. EDC lets farmers buy single-lot export credit insurance and reimburses up to 50% of cold chain logistics costs to preserve low-carbon certification. These perks are advertised openly on Export Development Canada's portal as weapons that embolden firms to raise standards and avoid rejection over residue tests at destination ports. The domino effect is clear on the transport lines. The same week Canada signed CSKOEA, the U.S. Department of Agriculture tallied only 30 grain ships loading in the Gulf, down 14% from a year earlier, with 10-day bookings off 17%. Reuters warns U.S. importers are starting to pivot to Vancouver because Canada's rail grid runs straight into the Midwest, capitalizing on cheaper backhaul rates when empty boxes return from Asia. In other words, North America's grain compass has swung. Capital, vessels, and contracts all tilt toward the maple leaf. From a blockchain tag to a double-digit premium, Canada has shown America a new game. When global standards spin green, the quick mover not only dodges return shipments, it pockets billion-dollar handshakes. And while Iowa farmers are slashing losses, the clock in Toronto keeps ticking, counting fresh orders even as the CBOT board stays red. American corn once dominated global menus, yet the historic return shipment has pushed the entire Corn Belt into a flashing red zone. As the grain and corn export icon wobbles, the whole U.S. agri-chain, from soybeans and beef to milk, suddenly turns into domino pieces poised to topple. If Washington fails to act, that collapse will swell into soy, where 92% of acreage is GMO. Seed Europe has already struck from its low-carbon whitelist. From there, the crack will spread to dairy. Feed costs climb, and small farms face the biggest bankruptcy wave since the 1980 crisis. Beef will struggle even more, because every pound raised on dirty corn will carry a heavier carbon tax than Canadian or Australian meat. Two rivals that have pledged net zero by 2030. In this landscape, the White House has only two tracks to choose. First, hit the brakes on protectionism, cut tariffs on green equipment, open the door to blockchain traceability, and share the same carbon rules with trading partners. This scenario demands a steep political price, but it buys a ticket back to the bargaining table and a chance to rebuild trust in U.S. farm goods. Second, keep the tariff walls up, maintain